participate in a pool, a diversified pool of primarily residential mortgages across either the country or in a specific geographic area, and then derive the interest from that pool of diversified mortgages net of the management fees that go to the manager.
The problem I have with the structure, and correct me if I'm wrong, is there's no chance for me to get capital appreciation. In real estate, one of the long-term benefits beyond the yield that comes out through a REIT, for example, of which I own many, is I get a slow increase in the net asset value of the underlying asset.
That's right.
I don't get that here.
Well, you've hit on a major difference between, say, REITs and MICs. A lot of people kind of lump them together, but REITs are truly investments in real estate. MICs are investments in the real estate sector, because really what they are is fixed income investments. So while it's true that you have no chance of capital appreciation on the downside, the upside is that you have almost no chance of capital depreciation either, because if they're structured properly, you're not playing in the equity game, you're playing in the debt game.
How volatile is this kind of investment? If you put money into it, what are you looking at?
Well, volatility, it depends on how you're measuring it. Typically, the value of the underlying asset, which in most cases is the value of, for example, of a preferred share that you purchase in a MIC, it has zero volatility. What's volatile is the return from year to year, because it's directly, say, 300 or 400 basis points higher than, say, the bank rate, depending what that rate is. And so, ironically, because of the short duration of most of the loans, when interest rates go up, it's actually a good thing for MIC holders, because in the relatively short term, they're going to see an uptick in their returns without taking on any extra risk.
But David, basically, am I not tying up my capital for 2 years with no liquidity and locking myself into sub 6% yield?
Well, no. When you say it depends on what the mix of the mix are. So some of them are fully first mortgages, some of them have a blend of first and seconds, and some of them are more in the second area, which is not something that I would generally cover. You are stuck in the sense that there are early redemption fees. You're not usually stuck for 2 years without being able to get out at all. But we both know, of course, that a redemption fee can wipe out any of the gains you had over that time. But it's definitely for a long-term investor. But of course, real estate investing was never meant to be a money market fund.
Can you give me some of your picks, what you like, which ones you like?
Sure. Well, three that we cover are the Magenta MIC, which is in Magenta and is in Eastern Ontario, and Miccio, which is Eastern Ontario as well. Both have the same style of lending. And then Canadian Horizons is run by our friends at CareVest, which is much larger.
Give us the yields on these.
Western.
What kind of yield are we talking?
You're looking at Canadian Horizons, for example, which offers three different, which is either firsts, seconds, or a blend of the two, can go anywhere between, say, 6% in the last year to about 9.5, 10 at the outer edge of the risk level, where you're actually getting closer to the equity that we talked about before and away from the debt portion that we talked about. And of course, interest rates are unlikely to go down, so those are likely to probably increase in the near term.
10 seconds. What proportion of somebody's portfolio should be in a MIC?
Oh, well, if 10% of their portfolio should be in alternatives at all, maybe only 10% or 20% of that should be in a MIC. And if I were buying a MIC or advising a client today, I would say pick 2 or 3 and then go in that direction. I wouldn't just go for one alone.
All right, David, great to see you.
Pleasure.
David Kaufman.